Plan for America podcast is a show dedicated to national unity through prosperity that's achieved by free market capitalism. We believe that a rising tide does lift all boats. This show will be positive, solution-oriented, and nonpartisan. Our only agenda is for the prosperity of our country and her people. All are welcome here. This show will not be argumentative or incendiary, sensational, or polarizing and divisive. What we are presenting is a positive solution to one of America's greatest problems. All right. Idanna, I want to ask you about being a portfolio manager because we have long thought that portfolio managers are kind of the rock stars of the investment world, that the best money managers in the world gravitate to become portfolio managers, not unlike the best professional athletes play in professional sports. It's kind of that analogy. So can you tell us a little bit what it's like to be a portfolio manager?
That's great. Thank you so much. So the fund that I'm on, Income Builder Fund, we're looking to generate income as well as capital appreciation in the fund over time. And it is an interesting fund because it invests both in equities corporate bonds, as well as sovereign bonds. And so we, as the head of our sovereign team, I'm the portfolio manager, one of the portfolio managers on that fund. And the reason I like it and I enjoy it is it forces one to look at risks and returns, not just in their own assets that they're looking at, so the sovereign bond space, but comparing that to opportunities in the equity space as well as in the corporate bond space. So it helps, I think, sort of broaden one's perspective and constantly be thinking about where can we earn sort of the best risk reward for our clients. Another aspect that I like about First Eagle is even the portfolio managers still have some research coverage that they engage in. So for me, it's useful both looking at my own sovereign credits that I have in my portfolio to cover, but then in a much broader perspective, looking across the sovereign landscape and across the risk return profile for equities and debt. So it's constantly, there's always something happening, and certainly in today's markets where volatility has been very high, there's always something interesting to look at and to sort of retest one's hypothesis. And sometimes we see that risks that might be priced one way in one set of markets and equity markets might look very differently from the bond market perspective. So again, that's can also help one find sort of the sort of pockets of risk reward in global capital markets.
Well, thank you. That's a great answer. And it leads kind of to my next question then, because as we're doing this recording here in the fourth quarter of 2022, it has been a very volatile year, as you pointed out. It's also been a very down year for equities. Well, for bonds also, with rising interest rates. So there hasn't been a lot of places to hide. What are some, in general, specific strategies, general specific, but what are some strategies you're using to combat these market conditions this year? I mean, what are some of the approaches you are taking?
Yeah, no, that's a great question. And as you mentioned, it's been a very difficult year with both, and I'm sure most people at home are feeling the same thing, both with equities and bonds, both down. It's really, even sort of safe assets are not providing safe assets are not providing that ballast. So, part of it for us at First Eagle, I think our process, we're very long-term investors and we take a very patient attitude. And so part of our strategy is unchanged, which is, we try to be very disciplined about when we deploy capital, only deploying capital when we think an investment will be profitable over the medium term. So the nice thing about that approach is we came into this period with a fair amount of, higher than normal cash in our portfolios, so that we're able to redeploy when markets come down, to redeploy into cheaper assets that we think will perform over the medium term. So, I think the most important thing is not panicking and taking a deliberate approaching and sticking with Juan's process. The other thing, that has been interesting, so as someone who looks at sovereign debt, the last many years have been, last 5-10 years have been kind of a very depressing place to look across the world at sovereign debt. Risks are have been rising, debt stocks are growing, but the compensation, the yields on that debt were quite low. And so, it had been quite a frustrating experience, again, not really seeing much value for one's money in the sovereign debt space for, say, the past 10-15 years. So the nice thing now is we're starting to see yields rising. Maybe there are more opportunities going forward, but we're still being very disciplined about putting that money to work, not taking a lot of duration at this time, just given the risk that yields could still rise farther, and we don't want to lose, we don't want to lose our clients' money. So it's a very deliberate, patient strategy. I think going forward, we're, if you had talked to us, talked to me a couple of years ago, I would have said this sort of the global opportunity set was kind of was dim, sort of looking forward, but we're starting to get a place where assets are priced more fairly. And so hopefully prospective returns will look better. But right now we're in this period of down markets and volatility. So obviously painful for those who have had to go through that process.
Yes, no doubt. And the wild card thrown into that whole mix is continued inflation. You talked about having a large cash position, which is one thing when interest rates are really, really low, but a large cash position when inflation is high is another matter. So what are your thoughts going forward on inflation? Are the central banks going to tame it? I mean, I don't know if you guys don't do specific forecasts maybe, but just kind of in general, what's your outlook on inflation?
Sure. And I should say one other thing that we use in our portfolios, something that you may know about First Eagle, is we do use gold as a potential hedge in our portfolio. So it's not a tactical position, but we sort of have a strategic allocation to gold, which does help us perform well in both sort of risk off as well as high inflation periods. So that's sort of the other buffer in the portfolio. So inflation's been very interesting. So I'm an economist by training, which is probably economists right now are not very well loved given the problems they've had forecasting inflation over the past several years. It is interesting. So I think there are some dynamics of inflation that are starting to look a bit better, but I think we still have to be cautious about where we're going. So if you looked at the drivers of inflation, the first big driver of inflation we had was coming from durable goods. And this was really caused by the pandemic, very strong demand for TVs, washer dryers, computers, all that stuff. So demand much higher than normal, met with restricted supply. So the whole supply chain story that we've had. So we have very sharp inflation in that sector. That's a sector that typically you would see deflation of about 2% per year, and at its peak, inflation in that sector was running about 12%. So a huge swing in inflation in that sector. That has started to roll off as we've reopened economies. Demand is moving towards the service sector as supply chains slowly improve, and as some of these inventories, firms are starting to discount their inventories, trying to move product. So we're starting to see prices come down in that sector. The sort of second driver of inflation has been commodity prices, obviously food and energy stemming from Russia's invasion of Ukraine. That has just seemingly peaked and started to roll over. We'll have to again see if that's a durable shift in inflation dynamics. But the part that is still worrisome to me is service sector inflation. So that's about 2/3 of the index. And there we've seen no moderation, just a gradual sort of creep up in service sector prices running 5-6% year on year at this point in time. And that, there are aspects of that, sort of those related to housing. Higher interest rates over time should begin to bring inflation down in that sector as housing prices fall, as rents fall, but that will take time. But then the other part that is really tied to wages and labor, that is still rising. And so this is why I think right now we're in this period where many people believe it's going to take a recession or some increase in unemployment to really cool the labor market, bring down wages, and sort of durably bring down inflation. So we're seeing some progress on the inflation front, but I think the hardest part is left, and the most painful part, unfortunately, that would be associated with higher unemployment, is yet to come. And then I think thinking sort of medium term, a real question of sort of the drivers of inflation. So as I said, that sort of durable goods inflation that typically was in deflation, do we move back to a deflationary stance? Do sort of the changes that we're seeing in globalization, sort of relocation of supply chains, the green energy transition, are these factors that keep sort of the durable goods and food and energy prices from coming down sort of to the levels we've historically expected, or did those run hotter than sort of we've seen historically? So I think that sort of the jury's still out on that. But if you look at what markets are expecting, if you look at inflation expectations, so one of my favorite things to look at is what the market is pricing for inflation from years 5 to 10. So that's sort of the medium term and shouldn't be influenced by near-term things. That hasn't really moved up too much. It moved up a bit until we saw the Fed get a lot more hawkish in its language, and now has sort of come back in line with sort of long-term averages. So the general, market participants do not expect inflation to be a long-term problem, but we'll have to see if that expectation turns out to be the case.
Okay. All right. Well, I appreciate that overview. And if our listeners, our viewers want to learn more about First Eagle Funds, is there a website or something they could go and learn more about your company?
Yes, there is. First Eagle Investments. I'd have to, sorry.
First Eagle is spelled out. It's not one ST, it's FIRST, First Eagle.
Yes, sorry, it's FIRST, eagleinvestments.com.
FirstEagleInvestments.com. There you go. All right. Well, that's great. That's great. Idanna, thank you. We're going to take a break. We'll be right back with Idanna Appio on Plan for America podcast. If you like what you're hearing and want to learn more about Plan for America, visit our website at www.planforamerica.us. There's an extensive Q&A section there, and if you don't see a question you have, then please ask us by email. You can order our book, Plan for America, How to Place the American Dream on a Sure Foundation Forever. That can be found on Amazon.com. You can like us on Facebook. And if you really like what you're hearing, you're welcome to contribute through our website. Plan for America is a nonprofit 501c3 organization, and all contributions are tax deductible. And welcome back to Plan for America podcast. I'm your host, Eric Nager. Our guest today is Idanna Appio. She's a portfolio manager at First Eagle Investments for their Income Builder Fund. We just had a great discussion about what a portfolio manager does, what are some strategies to combat the bear market this year and inflation. Now we want to dive into a little bit about the plan. I think giving your background, your educational background and interests, Plan for America must have been an interesting topic for you. And I want to first ask what strikes you about the plan as you started reading about it and diving into it.
So thank you so much. So it's interesting. So it's someone who, as I said, I've spent my career looking at sovereign risk and looking globally because usually, they're the countries that have sovereign crises. You might have one or two in your history. And so you really have to take a global lens to see the different flavors of what occurs. If you look across, there's usually three types of crises: sovereign debt crises, financial crises, and typically more in emerging markets, a balance of payments crisis where there's a run on the currency. And obviously the most destructive are those where all three are taking place. So, one of the things I think is useful about this plan is really trying to, again, I think one of the most important things is to bring attention to the sovereign debt that we have, the debt that we have in the US economy, and begin to talk about how, what are some strategies for dealing with the stock of government debt in the US? One of the, I think perhaps one of the things I worry about is one of the missed lessons of the past decade from the economics community is that sovereign debt doesn't matter if you have a reserve currency. You've seen a number of prominent economists coming out and saying this, that if the debt is in your own currency, we don't have to worry about it so much, and sort of encouraging more fiscal spending by governments. And I would argue that that only works when interest rates are low, and really obscures some of the hidden costs associated with government debt. And we really should be thinking about a longer term picture. The US economy, other major economies are aging rapidly. Costs associated with aging, healthcare, pensions, Social Security in the US are going to be increasing dramatically. And so thinking a bit more long term about the challenges we're facing and trying to think of different strategies for coping with that. So, in the first instance, I think this plan is useful, and just as an attempt to think about what are alternatives to sort of doing business as usual, which is, putting money into these entitlement funds, growing them, having them buy debt, growing them that way, and sort of this sort of framework that we're under right now, which is quite unsustainable, where entitlements are growing much faster, and we don't have the resources to fund that.
It's absolutely unsustainable, and that is one of the reasons why it prompted us to bring forward this plan, which our attempt at a comprehensive solution. So, as a portfolio manager, then, what are some of the implications of some of the aspects of this plan? For example, the 15.3% payroll tax would be, instead of going to government, would be, when you opt into the plan, it could be diverted into a private account in your name, and it would be invested in an all market index of U.S. domiciled publicly traded companies. That 15.3% represents about $1 trillion a year. So $1 trillion a year going into the U.S. capital markets on a steady, reliable basis, we think would incent corporations to become publicly listed, for one thing, to get onto this index. Do you agree with that? What are some of the implications of this cash flow into markets, away from debt into more equities?
Yeah, no, so I think that's an interesting aspect of this plan. And I did want to note that there are, that listeners should be aware there are many countries around the world that use something similar to this. Have a portion or all of the retirement, the payments from the employee and the employers go into market vehicles. There are different flavors across the world. Some are run by the government, some are run by private companies. But so this is something that actually exists and does work in many countries around the world. And so thinking about what are some of the benefits, maybe we'll start at the macro level and then work into some of the micro, sort of the market implications. So anything that raises national savings is generally quite good for the macroeconomic soundness of the economy, tends to correlate with smaller current account deficits, provides more funds available for investments domestically, so tends to boost growth. Investment tends to be the key driver of productivity growth over the medium term. So the more you raise the savings and it goes into investments, the higher the productivity growth. So I think from a macro perspective, it tends to be associated with very positive outcomes. Sort of then turning to your micro questions, yeah, it is a very interesting idea, this idea of more funds coming into US capital markets. Now, the US already has the world's deepest, most liquid global capital markets, but this would only improve that. And I think one of the points that you mentioned here, which I think is really interesting, is how do we get smaller businesses to access to equity capital? And there are a lot of benefits associated with that. Listing, being public, correlated with better governance, more productivity. So to the extent that you can get smaller firms to start accessing capital that way, I think that would be very useful. So again, improving depth, less, it should lower the cost of capital, encourage investments. This idea of encouraging, there would be, again, on the margin and incentive, this would be a huge pool of capital that would be coming into the US markets, would encourage both foreign capital probably to come into our markets, and to your perspective, maybe encourage companies to buy foreign companies or to partner with a domestic company in order to access that pool of liquidity. So it could be very powerful as a way to drive investment in the economy.
Great. Well, as you mentioned the saving rate. I mean, overnight, the saving rate would go to 15.3%, which is huge, huge. Nothing like we've ever had before. We also theorize that inflows like this would mitigate against volatility in the market, because there'd always be buyers all the time. And furthermore, because our plan also covers healthcare, universal healthcare for every U.S. citizen, where the premiums are paid automatically. Healthcare is 1/6 of the U.S. economy right now. It would be basically recession-proof under this plan. It would be immune from market gyrations because the premiums are always going to be paid. So with the healthcare piece and the continual flows mitigating against volatility, what is your thought on that? That's our theory, but what's yours?
No, I think that makes sense when you, for instance, maybe this is a little off topic, but a recent example I think it's useful to point to is Mexico. They have a setup like this, and slightly different because a lot of their the domestic portion of the investment goes into their government bond market. But one thing that has occurred, because these pension assets have gotten so large and the flows are getting larger, during COVID, we didn't see the sort of typical, there was obviously volatility in the government bond market, but we didn't see the sort of crises that we've seen in the past in Mexico. And that was because you had this buyer that sort of steadily comes in and buys and participates in the market. So I think there are a lot of real world examples of when you have a steady buyer that's there, that they can come in and mitigate some of the volatility, but also very useful in sort of those real extreme scenarios where everybody's heading out of the market. Having a buyer that's steady and coming in sort of underpins the market and prevents volatility. So I do think that would be an interesting aspect to this. I guess one question I have for you is, thinking about government debt, I think this would be very helpful in reducing the steady upward trend in government debt. But certainly there's still a role for, I think, government debt in the US economy in terms of a safe asset for the financial system and for sort of the global system. The US Treasury serves as a safe asset more broadly. So there is a question I have for you is how do you think about both the benefit of keeping debt from rising too much, but also maintaining some debt so that it can serve these sort of safe asset functions?
Okay, yeah, that's a great question. Well, now keep in mind, as part of the terms of the contract, the trust would be able to float bonds. Okay, so that's a lot of it would come out, and because it's a public-private partnership with the U.S. government, and this would be set up by a contract, the U.S. government would guarantee the bonds and pay the interest on the bonds, because there's going to be a long transition period here where the current retirees have to get paid off. So the For America Security Trust, the private trust, is going to take 2% of all the assets in the accounts every year to pay off current retirees and eventually to retire all the unfunded liabilities. And depending on what you assume about market returns, that would happen sometime between 2054 and 2071. So in the meantime, during that transition, there will be large amounts of bonds floated by the trust and backed by the 2% cash flow. In fact, arguably that would be better paper than government paper. I don't know if you agree with that opinion, but anyway, there will be a big bond market still. And then, of course, the other 30% of the government expenditures, once you get Social Security and Medicare off their books, I mean, they could still float bonds for that if they needed to, if they wanted to. You know, it just wouldn't be as potentially harmful to the overall picture as it is today. Anyway, does that?
Yeah, no, that's very interesting. So you'd have a new form of a new type of safe asset, and that would be very useful.
Yes, we would for quite some time now. You know, the CBO only allows, Congressional Budget Office only allows us 6.2% returns on markets when historically the norm has been about 10.2 nominal. So, I mean, we think it would be closer to historical norm than lower, but I mean, it's better to be conservative, I guess, and to err on the low side. So
that makes sense.
Yeah. Anyway, so I mean, what are the implications therefore for the, because I do want to talk about bonds too. I mean, we think corporations would retire a lot of their bonds in order to get publicly listed, so there'd be less maybe private debt, but there still would be plenty of public-private partnership debt in this form of the trust for many years, if that makes sense. So what are the implications of that to you, I guess?
No, I think that would be helpful, as I said, when, you know, especially for small and medium-sized companies who are very much dependent on bank financing and growing sort of asset management financing. To some extent, sort of debt issuance, but that tends to be sort of the larger companies in the economy. I think that would be very beneficial to be able to move towards equity financing away from debt financing. And again, as I said, tends to, you know, in order to list, to be public, you'd have to open up your books, you might have to professionalize, your governance might have to improve, and that generally tends to be associated with better run, more profitable, more efficient companies. So I think in general, that would be helpful. And then sort of like what we saw during COVID, you know, not having, you know, this whole swath, you know, small and medium-sized enterprises employ the bulk of Americans. And so, you know, not having them so dependent on one source of financing as we saw during COVID, during the global financial crisis, but having access to this broader pool of capital, to your point about sort of minimizing recessions could also be quite helpful.
Well, Idanna, I think we're at time here. Thank you so much for being a guest, and join us next time for another edition of Plan for America podcast.
That's great. Thank you so much.
All right, yeah, we're almost at time. So I did want to ask you one more question, but I saw that our timer's almost out. So, but anyway, great guest. Thank you so much. This was dynamite stuff.
No, it's really interesting, and I do, you know, hopefully maybe we're going to be turning. I am strongly of the belief that the topic of fiscal sustainability is coming right back around the corner again. Sort of the era of QE really diminished that discussion because this sort of view that, well, interest rates are low and the central banks are just going to buy this stuff, so we don't have to worry about it. But as central banks begin to shed assets, is the interest costs on the debts rising, I think attention is going to come back to this topic. And so just again, more debate about what are the better ways to finance ourselves. Is there a better?
In touch with you about that. So I'll get your contact maybe from Eric, and we can send you updates whenever we have them.
No, that'd be great. Yeah, I think this is very timely. So thank you.
Awesome. Well, you were a great guest. I tell you, this is we might want to have you on again. If you like what you're hearing and want to learn more about Plan for America, visit our website at www.planforamerica.us. There's an extensive Q&A section there, and if you don't see a question you have, then please ask us by email. You can order our book, Plan for America: How to Place the American Dream on a Sure Foundation Forever. That can be found on Amazon.com. You can like us on Facebook, and if you really like what you're hearing, you're welcome to contribute through our website. Plan for America is a nonprofit 501c3 organization, and all contributions are tax deductible.